Question 1. Upon reviewing the operational procedures for a FINRA-regulated broker-dealer in New York, a general securities principal has identified that the firm's current disclosure process for extended hours trading may not fully meet regulatory expectations. The principal needs to implement a revised disclosure strategy. Which of the following approaches best ensures compliance with FINRA Rule 2232 and robust investor protection regarding extended hours trading? Option A. Update the firm's general account opening disclosure to include a brief mention of potential risks associated with trading outside regular market hours. Option B. Develop a clear, written risk disclosure statement specifically detailing the unique risks of extended hours trading. Provide it to customers before they engage in such trading, and obtain a signed acknowledgement of receipt and understanding. Option C. Rely on the assumption that experienced traders are already familiar with the risks of extended hours trading and therefore do not require a specific disclosure from the firm. Option D. Provide customers with the extended hours trading risk disclosure only when they explicitly inquire about trading during non-regular market hours. Correct answer is B. Develop a clear written risk disclosure statement specifically detailing the unique risks of extended hours trading. Provide it to customers before they engage in such trading, and obtain a signed acknowledgement of receipt and understanding. Explanation. Scenario analysis. This scenario presents a common implementation challenge for broker-dealers operating under FINRA rules, specifically concerning the disclosure requirements for extended hours trading. The challenge lies in ensuring that all necessary disclosures are made effectively and in a manner that is easily understood by the customer, while also balancing the operational demands of the firm. A principal must exercise careful judgment to navigate the nuances of regulatory compliance and customer protection in a dynamic trading environment. The risk of non-compliance, leading to regulatory sanctions and customer harm, is significant. Correct approach analysis. The best professional practice involves a proactive and comprehensive approach to disclosure. This includes providing customers with a clear, written statement detailing the risks associated with trading outside of regular market hours, such as increased volatility, wider spreads, and the potential for lower liquidity. This disclosure should be provided asterisk before asterisk. A customer engages in extended hours trading and should be easily accessible for review. Furthermore, the firm should implement a system to confirm that the customer has received and understood this disclosure, perhaps through a signed acknowledgement. This approach directly aligns with FINRA Rule 2232, which mandates that firms provide customers with a risk disclosure statement for extended hours trading. The emphasis on pre-trade disclosure and confirmation ensures that the customer is fully informed and has the opportunity to make a reasoned decision, thereby fulfilling the regulatory obligation to protect investors. Incorrect approaches analysis. One incorrect approach involves relying solely on a general disclosure statement provided at account opening that broadly mentions market risks without specifically addressing the unique risks of extended hours trading. This fails to meet the specificity required by FINRA rules, which mandate explicit disclosure of extended hours trading risks. Customers may not connect general market risk statements to the amplified risks present during non-standard trading sessions. Another incorrect approach is to provide the extended hours trading risk disclosure only upon the customer's first request to trade outside regular hours, without any prior proactive notification. This reactive approach risks the customer executing trades without a full understanding of the associated risks, potentially leading to unexpected losses and a breach of the firm's duty to inform. A third incorrect approach is to assume that customers who actively trade are inherently aware of extended hours trading risks and therefore do not require a specific disclosure. This assumption is a significant regulatory and ethical failure. FINRA rules are designed to protect all investors, and the firm has a responsibility to ensure that even sophisticated traders are explicitly informed of the specific risks of extended hours trading, regardless of their perceived level of experience. Professional reasoning. Professionals should adopt a framework that prioritizes investor protection through clear, timely, and specific disclosures. This involves understanding the specific regulatory requirements for each type of trading activity, such as extended hours trading. The process should include 1. Identifying all applicable regulatory rules, e.g., FINRA Rule 2232. 2. Developing disclosure materials that are accurate, comprehensive, and easily understandable. 3. Implementing a robust system for delivering these disclosures to customers before they engage in the relevant activity. 4. Establishing a mechanism to confirm customer receipt and understanding of the disclosures. 5. Regularly reviewing and updating disclosure procedures to ensure ongoing compliance and effectiveness. Question 2. When evaluating a potential new associate in California who previously worked for a member firm that was subject to a statutory disqualification by FINRA, what is the most prudent course of action for a general securities principal to take to ensure compliance with applicable regulations? Option A. Conduct a thorough review of the prior firm's disciplinary history, the nature of the statutory disqualification, and the associate's specific role and responsibilities during that period, and if necessary, implement enhanced supervisory procedures. Option B. Proceed with the association, assuming the associate is suitable as long as they were not personally named in the disciplinary action against the prior firm. Option C. Rely solely on the associate's verbal assurance that they were unaware of any misconduct at the previous firm and that their role was administrative. Option D. Prioritize the associate's immediate onboarding to meet business needs, deferring a detailed review of the prior firm's regulatory issues until after the association is established. The correct answer is A. Conduct a thorough review of the prior firm's disciplinary history, the nature of the statutory disqualification, and the associate's specific role and responsibilities during that period, and if necessary, implement enhanced supervisory procedures. Explanation. This scenario presents a professional challenge because a registered principal must assess the implications of an associate's past association with a firm that faced regulatory action. The principal's responsibility extends beyond merely onboarding a new associate. It requires a proactive and thorough investigation into any potential conflicts or regulatory concerns that could impact the current firm's compliance and reputation. Careful judgment is required to balance the need to expand the firm's capabilities with the paramount duty to uphold regulatory standards and protect investors. The best approach involves a comprehensive review of the prior firm's disciplinary history and the associate's specific role and responsibilities within that firm. This includes understanding the nature of the statutory disqualification, the reasons for the action against the prior firm, and whether the associate was personally involved in or aware of any misconduct. This proactive due diligence is crucial for fulfilling the principal's supervisory obligations under FINRA rules, specifically regarding the association of persons subject to statutory disqualification. By gathering all relevant information, the principal can make an informed decision about the associate's suitability and implement appropriate supervisory measures if the association is permitted. This aligns with the ethical imperative to maintain the integrity of the securities markets and protect the investing public. An incorrect approach would be to assume that because the associate was not personally named in the disciplinary action, there is no risk. This overlooks the principle that a firm's statutory disqualification can create a presumption of risk for individuals associated with it, and a principal has a duty to investigate further. Another incorrect approach is to rely solely on the associate's self-reporting without independent verification or a deeper inquiry into the circumstances surrounding the prior firm's regulatory issues. This abdication of supervisory responsibility can lead to violations of FINRA Rule 3110, Supervisory System, and potentially expose the firm to significant regulatory penalties. Finally, an approach that prioritizes immediate business needs over thorough compliance review, such as proceeding with the association without a complete understanding of the regulatory history, demonstrates a disregard for the firm's obligations and the potential harm to clients and the firm's reputation. Professionals should adopt a decision-making framework that begins with identifying potential regulatory red flags, such as an associate's prior association with a statutorily disqualified firm. This should be followed by a commitment to thorough due diligence, including reviewing public disciplinary records and engaging in direct, detailed conversations with the associate. If concerns remain, seeking guidance from the firm's compliance department or legal counsel is essential. The ultimate decision should be based on a comprehensive assessment of risk and a clear understanding of how the association aligns with regulatory requirements and the firm's ethical obligations. Question 3. The analysis reveals that a mid-sized broker-dealer in California, operating under FINRA regulations, is experiencing significant challenges in consistently generating accurate and timely account records and transaction reports. The current process relies heavily on manual data input by administrative staff and periodic compilation by department managers, leading to occasional discrepancies and delays in report generation. Chief Compliance Officer is tasked with recommending an improved system to ensure adherence to FINRA record-keeping and reporting requirements. Which of the following represents the most effective and compliant strategy for the firm? Option A. Implement a fully integrated automated compliance system that captures all transaction data in real time, generates required reports automatically, and maintains a secure, auditable electronic record of all account activity. Option B. Focus on developing robust procedures for responding to FINRA examination requests, ensuring that all requested records can be retrieved, even if they are not consistently maintained in real time. Option C. Delegate the responsibility for maintaining individual account records and generating reports to each registered representative, with a requirement for them to submit their records quarterly. Option D. Continue with the current manual data entry and compilation process, but increase the frequency of internal audits to catch errors before reports are finalized. The correct answer is A. Implement a fully integrated automated compliance system that captures all transaction data in real time, generates required reports automatically, and maintains a secure, auditable electronic record of all account activity. Explanation. The analysis reveals a scenario that is professionally challenging due to the inherent tension between a firm's operational efficiency and its stringent regulatory obligations regarding record-keeping and reporting. The compliance officer must navigate the potential for human error and the critical need for accurate, timely data to satisfy FINRA requirements, specifically concerning the maintenance and accessibility of account records and the reporting of certain transactions. The firm's reliance on manual processes introduces significant risk, making the selection of the most robust and compliant approach paramount. The best approach involves implementing a comprehensive, automated system for generating and storing all required account records and transaction reports. This system should be designed to capture all relevant data points accurately at the point of transaction, ensuring immediate availability and auditability. Regulatory justification stems directly from FINRA Rule 4511, General Supervision and Maintenance of Records, which mandates that firms maintain accurate and current books and records. Furthermore, rules governing the reporting of specific transactions, e.g., those related to suspicious activity or large trades, require timely and precise submission, which an automated system is best equipped to handle. This approach minimizes the risk of omissions, inaccuracies, and delays, thereby upholding the firm's duty of supervision and compliance. An incorrect approach would be to continue relying solely on manual data entry and periodic manual compilation of reports. This method is highly susceptible to human error, such as data transposition, missed entries, or delayed submissions. The regulatory failure lies in the increased likelihood of violating FINRA Rule 4511 by not maintaining accurate and current records, and potentially failing to meet reporting deadlines for specific transactions, which could trigger regulatory scrutiny and penalties. Another incorrect approach is to delegate the responsibility of record compilation and report generation to individual registered representatives without adequate oversight or a standardized, automated process. While representatives are responsible for their activities, the ultimate responsibility for the firm's books and records rests with the firm itself. This approach creates a fragmented and inconsistent record-keeping system, increasing the risk of non-compliance and making it difficult for the firm to conduct effective internal audits or respond promptly to regulatory inquiries. The ethical failure here is a lack of robust supervision and a failure to implement systems that ensure compliance across the entire organization. A further incorrect approach would be to only generate reports when specifically requested by FINRA or during scheduled examinations. This reactive stance directly contravenes the proactive requirements of record maintenance and reporting. FINRA rules require ongoing maintenance and timely reporting of certain information, not just in response to external demands. Failing to maintain current records and generate reports as required by regulations, even if not immediately apparent to the firm, constitutes a significant regulatory breach. Professionals should employ a decision-making framework that prioritizes regulatory compliance and risk mitigation. This involves understanding the specific FINRA rules applicable to record keeping and reporting, assessing the inherent risks of current operational processes, and selecting solutions that demonstrably reduce those risks while ensuring adherence to all regulatory mandates. A proactive, system-based approach to compliance, rather than a reactive or ad hoc one, is essential for maintaining the integrity of the firm's operations and its relationship with regulators. Question 4. The performance metrics show a consistent need for ongoing professional development among registered representatives in California. As a general securities principle, what is the most effective and compliant approach to managing both the regulatory element and firm element continuing education requirements for your team? Option A. Wait until a representative is close to or has missed their continuing education deadline before taking any action. Option B. Proactively track representatives approaching their continuing education deadlines and schedule or facilitate the required training well in advance. Option C. Rely on individual registered representatives to independently manage and complete all their continuing education requirements without firm oversight. Option D. Prioritize firm element training over the regulatory element, due to greater firm control over its content and scheduling. The correct answer is B. Proactively track representatives approaching their continuing education deadlines and schedule or facilitate the required training well in advance. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to balance the firm's operational efficiency and resource allocation with the absolute regulatory mandate for continuing education. The principal must ensure compliance without compromising the firm's ability to serve clients or incurring unnecessary costs, all while upholding ethical responsibilities to their registered representatives. Careful judgment is required to interpret and apply the regulatory requirements in a practical, yet compliant, manner. Correct approach analysis. The best professional practice involves proactively identifying registered representatives who are approaching their regulatory deadlines for the regulatory element and the firm element continuing education in California. This approach ensures that the firm can schedule and facilitate the required training in a timely and organized fashion, minimizing the risk of noncompliance. By integrating this tracking into the firm's regular supervisory processes, the principal demonstrates a commitment to ongoing compliance and professional development for their team, which aligns with FINRA Rule 1250 and the California Corporations Code, Division 1, Chapter 1, Article 1, Section 25232, which implicitly requires principals to supervise for compliance. Incorrect approaches analysis. One incorrect approach involves waiting until a representative is on the verge of a compliance deadline or has already missed it before addressing their continuing education. This reactive strategy creates a high risk of regulatory violations, potential disciplinary actions from FINRA and the California Department of Financial Protection and Innovation, and could lead to the representative being unable to conduct business. It demonstrates a failure in proactive supervision and a disregard for the importance of ongoing regulatory and firm-specific training. Another incorrect approach is to assume that all registered representatives will independently manage their continuing education requirements without any firm oversight. While individuals have a personal responsibility, the principal's role includes ensuring that the firm has systems in place to monitor and facilitate compliance. This hands-off method can lead to widespread noncompliance, as representatives may overlook deadlines, face technical issues with online modules, or lack access to approved training, all of which would fall under the principal's supervisory purview. A further incorrect approach is to prioritize the firm element training over the regulatory element simply because the firm has more control over the content and scheduling of the former. Both elements are mandatory and carry distinct regulatory weight. Neglecting the regulatory element, which is mandated by FINRA and state regulators, exposes the firm and its representatives to significant compliance risks and penalties. Professional reasoning. Professionals should adopt a proactive and systematic approach to managing continuing education requirements. This involves establishing clear internal processes for tracking deadlines, communicating expectations to registered representatives, and providing accessible resources for both regulatory and firm element training. Regular review of these processes and individual representative compliance status is crucial. When faced with potential noncompliance, the immediate priority should be to rectify the situation in accordance with regulatory guidelines. followed by an analysis of the root cause to prevent future occurrences. This demonstrates a commitment to ethical conduct, regulatory adherence, and the professional development of the team. Question 5. Implementation of a new branch office in Boca Raton, Florida, requires a general securities principle to ensure all necessary registrations are filed. Following the successful opening and operation of this office for 2 years, the firm decides to close it due to a strategic realignment. What is the most appropriate action for the general securities principle to take regarding the registration of this physical office location in Florida? Option A. Wait until the end of the fiscal year to include the termination filing as part of the firm's annual compliance reporting. Option B. Assume that ceasing operations at the Boca Raton location automatically cancels its registration with regulatory bodies. Option C. Promptly initiate the formal termination of the broker-dealer's registration for the Boca Raton physical office with FINRA and the Florida Office of Financial Regulation. Option D. Only initiate the termination process if the Florida Office of Financial Regulation contacts the firm regarding the office's status. The correct answer is C. Promptly initiate the formal termination of the broker-dealer's registration for the Boca Raton physical office with FINRA and the Florida Office of Financial Regulation. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a general securities principle to understand and execute the critical regulatory process of initiating and terminating broker-dealer and physical office registrations within a specific jurisdiction. Mismanagement of these processes can lead to significant regulatory violations, fines, and reputational damage for the firm and the principal. The principal must navigate FINRA rules and state securities laws to ensure compliance, demonstrating a thorough understanding of the firm's operational footprint and its legal obligations. Correct approach analysis. The best professional practice involves a proactive and meticulous approach to managing the firm's registration status. This includes maintaining an up-to-date internal record of all physical office locations, regularly verifying their operational status and compliance with state registration requirements, and promptly initiating the termination of registration for any location that is no longer operational or required. This approach ensures continuous compliance with FINRA Rule 3010 and relevant state securities laws, preventing potential lapses in registration and associated penalties. It demonstrates a commitment to regulatory adherence and operational integrity. Incorrect approaches analysis. Initiating the termination of registration only when a physical office has been vacant for an extended period, without a clear internal policy for regular review, is a failure to proactively manage registration requirements. This can lead to a period where an unregistered location is being operated, or where the firm is paying for registrations that are no longer necessary, both of which are regulatory concerns. Failing to initiate the termination of registration for a physical office until a formal inquiry or audit is received from a state securities regulator or FINRA is a reactive and negligent approach. This indicates a lack of internal controls and a disregard for ongoing compliance obligations, significantly increasing the risk of regulatory sanctions. Assuming that the termination of a physical office's business operations automatically triggers the termination of its registration with regulatory bodies is a critical error. Registration is a formal process that requires specific filings and approvals. An operational cessation alone does not absolve the firm of its registration responsibilities. Professional reasoning. Professionals should adopt a systematic and forward-thinking approach to managing firm registrations. This involves establishing clear internal procedures for tracking all physical office locations, assigning responsibility for their oversight, and implementing a schedule for regular reviews of operational status and registration compliance. When a location ceases to be operational or necessary, the principal must immediately initiate the appropriate termination filings with both FINRA and the relevant state securities regulators. This proactive stance minimizes regulatory risk and ensures the firm operates in full compliance with all applicable laws and rules. Question 6. To address the challenge of securely retaining electronic communications for a broker-dealer operating in California, a registered principal must ensure compliance with SEC Rule 17A4D. Which of the following approaches best satisfies the regulatory requirements for electronic record storage? Option A. Engaging a specialized third-party service provider that utilizes dedicated, non-erasable, non-rewritable electronic storage media designed for regulatory compliance. Option B. Relying on the standard archiving feature of the firm's email server, which retains messages for a period of 2 years before they can be purged by IT staff. Option C. Implementing a cloud-based storage solution that offers password protection and allows for file modifications under administrator control for data management purposes. Option D. Utilizing the firm's existing local network-attached storage (NAS) device, assuming it has sufficient capacity and is accessible by firm personnel. The correct answer is A. Engaging a specialized third-party service provider that utilizes dedicated, non-erasable, and non-rewritable electronic storage media designed for regulatory compliance. Explanation. Scenario analysis. This scenario presents a professional challenge for a registered principal in California concerning the retention of electronic records under SEC Rule 17A4D. The core difficulty lies in balancing the firm's operational efficiency and cost-effectiveness with the absolute regulatory mandate for secure, unalterable, and readily accessible record preservation. A principal must ensure that the chosen method for storing electronic communications not only complies with the letter of the law, but also the spirit of investor protection and regulatory oversight. Failure to do so can result in significant penalties, reputational damage, and harm to clients. Correct approach analysis. The best professional practice involves implementing a system that utilizes a dedicated, third-party electronic storage media that meets the specific requirements of Rule 17A4D. This approach is correct because it directly addresses the rule's stipulations for non-erasable, non-rewritable storage and the ability to promptly retrieve records. Partnering with a reputable service provider specializing in regulatory compliance for financial firms ensures that the technology and processes are designed to meet SEC requirements, including data integrity, security, and accessibility for the required retention period. This proactive and compliant method minimizes the risk of regulatory violations and demonstrates a commitment to sound record-keeping practices. Incorrect approach is analysis. Using a cloud-based storage solution that allows for file modification or deletion, even if password protected, is an incorrect approach. Rule 17A4D explicitly prohibits storage media that permit the alteration or deletion of records. Convenient, such a system fails to guarantee the immutability required by the SEC. Employing a local network-attached storage (NAS) device that is not specifically designed for regulatory compliance and lacks robust audit trails for data access and modification is also an incorrect approach. The rule requires that records be maintained in a way that prevents alteration or deletion and can be readily produced. A standard NAS might not offer the necessary safeguards or the ability to prove the integrity of the stored data over time. Relying on the firm's standard email server's built-in archiving feature, which may have limited retention periods or allow for administrator-initiated deletions, is another incorrect approach. Such systems are typically designed for operational efficiency rather than long-term, immutable regulatory record-keeping, and may not meet the stringent requirements for data integrity and accessibility mandated by Rule 17A4D. Professional reasoning. Professionals in California, when faced with electronic record retention obligations under SEC Rule 17A4D, should prioritize solutions that demonstrably meet the rule's requirements for non-erasability, non-rewritability, and prompt accessibility. This involves a thorough evaluation of storage media and service providers, focusing on their compliance certifications and audit capabilities. A risk-based approach, leaning towards established, specialized third-party solutions, is generally the most prudent. When in doubt, consulting with compliance experts or legal counsel specializing in SEC regulations is advisable to ensure full adherence and mitigate potential liabilities. Question 7. Examination of the data shows that a registered representative is proposing to offer a security issued by a private company in California that is not registered under the Securities Exchange Act of 1934. The representative believes this security is exempt from registration under Section 3A. 39 of the Securities Act of 1933 because the issuer is not a reporting company. As the general securities principle, what is the most appropriate course of action to ensure compliance with federal securities laws for this offering in California? Option A. Allow the offering to proceed based on the registered representative's assertion that the private company is not a reporting entity under the Securities Exchange Act of 1934, as this satisfies the primary condition of Section 3A, 39. Option B. Advise the registered representative to proceed with the offering, but instruct them to disclose to potential investors that the security is being offered under a claimed exemption and that its exempt status has not been independently verified by the firm. Option C. Verify that the issuer is not subject to the reporting requirements of the Securities Exchange Act of 1934 and confirm that the security is either issued by a bank or is a security issued or guaranteed by a person controlled or supervised by, and acting as an instrumentality of, a state or political subdivision thereof, before permitting the offering. Option D. Determine that since the security is being offered by a private company in California and is not registered under the Securities Exchange Act of 1934, it automatically qualifies for an exemption under Section 3A, 39 of the Securities Act of 1933. Correct answer is C. Verify that the issuer is not subject to the reporting requirements of the Securities Exchange Act of 1934 and confirm that the security is either issued by a bank or is a security issued or guaranteed by a person controlled or supervised by, and acting as an instrumentality of, a state or political subdivision thereof, before permitting the offering. Explanation. This scenario presents a professional challenge because it requires a principal to interpret and apply a specific exemption under the Securities Act of 1933, Section 3A, 39, which deals with the definition of an exempted security. The challenge lies in accurately determining whether a particular security meets the criteria for this exemption, thereby avoiding potential violations of registration and prospectus delivery requirements. Misinterpretation could lead to significant regulatory penalties and reputational damage. Careful judgment is required to distinguish between securities that qualify for this exemption and those that do not, based on the precise language and intent of the law. The best approach involves a thorough review of the issuer's financial condition and the nature of the security being offered, specifically focusing on whether the issuer is subject to the reporting requirements of the Securities Exchange Act of 1934, and whether the security is a security issued by a bank or a security issued or guaranteed by a person controlled or supervised by, and acting as an instrumentality of, a state or political subdivision thereof. This approach is correct because Section 3A, 39 of the Securities Act of 1933 explicitly defines exempted securities to include, among other things, securities issued by entities that are not subject to the reporting requirements of the Securities Exchange Act of 1934, and specifically enumerates securities issued by banks or governmental entities. A principal must verify that the issuer and the security fall squarely within these defined categories to rely on the exemption. An incorrect approach would be to assume that any security issued by an entity that is not a publicly traded company is automatically exempt under Section 3A, 39. This is a regulatory failure because the exemption is narrowly defined and requires specific conditions to be met, such as the issuer not being subject to the reporting requirements of the 1934 Act and the security fitting into one of the enumerated categories, e.g., bank securities, governmental securities. Simply being a private entity does not automatically qualify a security for this exemption. Another incorrect approach would be to rely solely on the issuer's representation that the security is exempt without independent verification. This is an ethical and regulatory failure because a principal has a duty of due diligence to ensure compliance. The firm and its principals cannot abdicate their responsibility to assess the applicability of an exemption based on the issuer's word alone. The principal must actively investigate and confirm the facts supporting the exemption. A further incorrect approach would be to consider the security exempt merely because it is being offered to sophisticated investors. While sophistication of investors is relevant to other exemptions, like Regulation D, Section 3A, 39 focuses on the nature of the issuer and the security itself, not the characteristics of the purchasers. This is a regulatory failure as it misapplies the criteria for exemption under Section 3A, 39. Professionals should employ a decision-making framework that prioritizes a meticulous review of the relevant securities laws and regulations. This involves understanding the specific criteria for each exemption, conducting thorough due diligence on the issuer and the security, and documenting the basis for any reliance on an exemption. When in doubt, seeking legal counsel or clarification from regulatory bodies is a prudent step to ensure compliance and protect both the firm and its clients. Question 8. Research into the background of a prospective registered representative applicant for a securities firm in California reveals a past FINRA disciplinary action for an undisclosed outside business activity. The hiring principal must decide whether to proceed with the application. What is the most appropriate course of action? Option A. Conduct a thorough review of the applicant's explanation for the past disciplinary action, verify their current registration status, and review their FINRA broker check record for any other disclosures or issues before making a hiring decision. Option B. Immediately reject the applicant's candidacy due to the past FINRA disciplinary action, as it indicates a lack of adherence to regulatory requirements. Option C. Proceed with hiring the applicant without further investigation, assuming the past disciplinary action was a minor oversight and the applicant is qualified. Option D. Rely solely on the applicant's verbal assurance that the disciplinary action was an isolated incident and that they have learned from the experience, without seeking any further documentation or verification. The correct answer is A. Conduct a thorough review of the applicant's explanation for the past disciplinary action, verify their current registration status, and review their FINRA broker check record for any other disclosures or issues before making a hiring decision. Explanation. This scenario presents a professional challenge because the hiring manager must balance the firm's obligation to maintain a high standard of conduct and protect its clients with the potential for an individual to have overcome past difficulties. The Series 24 General Securities Principal exam emphasizes the principal's responsibility in ensuring that all associated persons meet regulatory standards. The FINRA Rule 3110, supervision, and related guidance on hiring and supervision are paramount here. A principal must exercise due diligence in assessing an applicant's background, considering not just the existence of past issues, but also the nature, recency, and the applicant's demonstrated rehabilitation. The best approach involves a thorough, individualized assessment that goes beyond a simple check of the box. This includes obtaining a detailed explanation from the applicant regarding the past disciplinary action and any subsequent steps taken to address the issues. Furthermore, verifying the applicant's current registration status and reviewing any publicly available disciplinary history from FINRA broker check is crucial. This comprehensive review allows for an informed decision based on the totality of the circumstances, aligning with the ethical duty to supervise and the regulatory requirement to employ only qualified and trustworthy individuals. This approach prioritizes compliance and client protection while allowing for the possibility of rehabilitation. An approach that immediately disqualifies the candidate based solely on the past disciplinary action, without further investigation, fails to acknowledge the possibility of rehabilitation and may be overly punitive. While past misconduct is a serious concern, regulatory frameworks often allow for individuals to demonstrate that they have learned from their mistakes and are fit to work in the securities industry. Ignoring this possibility can lead to unfair hiring practices and potentially overlook qualified individuals who have successfully navigated past challenges. Another unacceptable approach is to overlook the disciplinary history entirely, assuming it is a minor issue or that the applicant is being truthful without verification. This demonstrates a lack of due diligence and a failure to uphold the principal's supervisory responsibilities. The firm has a duty to ensure that all its registered representatives meet regulatory standards, and a superficial review of an applicant's background directly contravenes this obligation. It exposes the firm to significant regulatory risk and potential harm to clients. Finally, an approach that relies solely on the applicant's self-reporting without any independent verification or further inquiry is also professionally unsound. While an applicant's candor is important, regulatory bodies expect principals to conduct their own investigations to confirm information and assess the full context of any disclosed issues. This lack of independent verification represents a failure in the hiring process and a disregard for the firm's supervisory duties. Professionals should adopt a decision-making framework that begins with understanding the regulatory requirements for hiring and supervision. This involves proactively identifying potential red flags in an applicant's background, such as past disciplinary actions, complaints, or financial difficulties. The next step is to conduct a thorough and individualized investigation, gathering all relevant information and seeking explanations from the applicant. This information should then be objectively assessed against regulatory standards and ethical considerations, focusing on the nature of the offense, the time elapsed, and evidence of rehabilitation. The final decision should be well documented and justifiable based on this comprehensive review. Question 9. Which approach would be most effective for a general securities principal in California to supervise the development, evaluation, and delivery of new investment products offered by their firm, ensuring both market competitiveness and regulatory compliance? Option A. Prioritize launching products that mirror those offered by successful competitors, assuming their market acceptance implies regulatory soundness. Option B. Allow the sales department to lead the product evaluation and approval process, focusing primarily on revenue potential and market demand. Option C. Conduct a brief review of competitor products and then proceed with development based on general market trends, with compliance oversight occurring only after the product is already in the market. Option D. Implement a phased product development process that includes early engagement with legal and compliance, rigorous suitability assessments for target client segments, and comprehensive risk disclosures before any product is launched. The correct answer is D. Implement a phased product development process that includes early engagement with legal and compliance, rigorous suitability assessments for target client segments, and comprehensive risk disclosures before any product is launched. Explanation. This scenario is professionally challenging because it requires a general securities principal in California to balance the firm's desire for innovation and market competitiveness with the paramount duty of investor protection and regulatory compliance. The principal must ensure that new product development is not only profitable, but also ethically sound and legally permissible under California and FINRA regulations. The pressure to be first to market can lead to shortcuts that compromise due diligence, potentially exposing both the firm and its clients to undue risk. Careful judgment is required to navigate these competing interests effectively. The approach that represents best professional practice involves a structured, multi-stage review process that prioritizes thorough risk assessment and compliance checks before product launch. This includes engaging legal and compliance departments early, conducting rigorous suitability analyses for target client segments, and ensuring clear disclosure of all associated risks and fees. This approach is correct because it directly aligns with FINRA Rule 3110, Supervision, and the general principles of responsible product development, which mandate that firms have adequate supervisory procedures to ensure that products offered are suitable for their intended investors, and that all relevant regulations are adhered to. It proactively identifies and mitigates potential compliance issues and client harm, fulfilling the principal's supervisory obligations. An approach that focuses solely on market demand and potential profitability without adequate risk assessment and compliance integration is professionally unacceptable. This failure to conduct thorough due diligence on the product's structure, associated risks, and suitability for various client profiles violates the fundamental principles of investor protection and FINRA suitability rules. It creates a significant risk of offering products that are inappropriate for clients, leading to potential regulatory sanctions, reputational damage, and client litigation. Another professionally unacceptable approach is to delegate the entire product evaluation and approval process to the sales team. This bypasses essential oversight from compliance and legal, increasing the likelihood of overlooking regulatory requirements or ethical considerations. The sales team's primary incentive is revenue generation, which can create a conflict of interest that compromises objective product evaluation and risk assessment, directly contravening the principal's supervisory responsibilities. Finally, an approach that relies on a cursory review of competitor offerings without independent analysis of the product's own merits and risks is also flawed. While competitive analysis is useful, it does not substitute for a deep understanding of the product's specific characteristics, its potential impact on clients, and its compliance with all applicable regulations. This superficial review risks adopting flawed or non-compliant product structures simply because competitors are doing so, failing to uphold the firm's duty of care. Professionals should adopt a decision-making framework that begins with understanding the firm's supervisory obligations under FINRA rules and California securities laws. This involves establishing clear internal policies and procedures for product development and review, ensuring that all new offerings undergo a comprehensive assessment of risks, suitability, and compliance. Collaboration between product development, sales, legal, and compliance teams is crucial. The principal must champion a culture of compliance and ethical conduct, ensuring that investor protection remains the highest priority throughout the product lifecycle. Question 10. Process analysis reveals that a registered broker-dealer in California, Pacific Securities, is undergoing a change in ownership, and its principal, Sarah Chen, is responsible for ensuring compliance with Rule 15b1-3 of the Securities Exchange Act of 1934 for the successor entity, Golden State Investments. Pacific Securities had a net capital of $500,000 as of its last financial report. The acquisition involves Golden State Investments injecting $200,000 in new capital and assuming $50,000 in outstanding liabilities from Pacific Securities. Sarah needs to determine the minimum net capital Golden State Investments must possess immediately upon succession. Option A. Golden State Investments must possess a minimum net capital of $500,000, which is simply the net capital of the predecessor firm. Option B. Golden State Investments must possess a minimum net capital of $650,000, calculated as the predecessor's net capital plus new capital contributions minus assumed liabilities. $500,000 plus $200,000 $50,000. Option C. Golden State Investments must possess a minimum net capital of $700,000, which is the sum of the predecessor's net capital and the new capital contributions. $500,000 plus $200,000. Option D. Golden State Investments must possess a minimum net capital of $750,000, which is the sum of the predecessor's net capital, new capital contributions, and assumed liabilities. $500,000 plus $200,000 plus $50,000. The correct answer is B. Golden State Investments must possess a minimum net capital of $650,000, calculated as the predecessor's net capital plus new capital contributions minus assumed liabilities. $500,000 plus $200,000 Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a principal to navigate the complex requirements of Rule 15b1-3 under the Securities Exchange Act of 1934, specifically concerning the registration of a successor broker-dealer. The challenge lies in accurately calculating the net capital requirements for the new entity, while ensuring all regulatory obligations are met promptly to avoid operational disruptions and potential violations. Misinterpreting the rule or making calculation errors could lead to significant compliance issues, including fines and reputational damage. Correct approach analysis. The best professional practice involves a meticulous calculation of the successor firm's net capital based on the aggregate of the predecessor's net capital and any new capital contributions, adjusted for any liabilities assumed or incurred. Specifically, the calculation should follow the formula: new firm net capital equals predecessor firm net capital plus new capital contributions liabilities assumed / incurred. This approach is correct because Rule 15b1-3 mandates that a successor firm must have at least the same net capital as the predecessor firm immediately prior to the succession. If new capital is injected or liabilities are assumed, these must be factored into the calculation to ensure the successor meets the minimum net capital requirements as of the date of succession. This ensures continuity of financial responsibility and investor protection. Incorrect approaches analysis. One incorrect approach involves simply using the predecessor's last reported net capital figure without accounting for any new capital injections or assumed liabilities. This fails to comply with the spirit and letter of Rule 15b1-3, which requires the successor to demonstrate its own adequate net capital position. This could result in the successor operating with insufficient capital, thereby violating the net capital rule and jeopardizing client assets. Another incorrect approach is to delay the net capital calculation and subsequent filing until after the operational transition has begun. Rule 15b1-3 requires the successor to file a new Form BD and demonstrate compliance with net capital requirements prior to or contemporaneously with the succession. Postponing this critical step creates a period of noncompliance, exposing the firm and its principals to regulatory scrutiny and potential sanctions. A further incorrect approach is to rely solely on the predecessor's financial statements without performing an independent calculation of the successor's net capital. While the predecessor's financials are a starting point, the successor's net capital must reflect its own financial condition at the time of succession, including any new assets, liabilities, or capital changes that occurred during the transition. This oversight can lead to an inaccurate assessment of the firm's financial health and compliance status. Professional reasoning. Professionals facing this situation should adopt a proactive and detail-oriented approach. First, thoroughly review Rule 15b1-3 and any relevant SEC guidance. Second, gather all financial information pertaining to both the predecessor and the successor, including balance sheets, capital contributions, and assumed liabilities. Third, perform a precise net capital calculation using the formula for successor firms. Fourth, ensure all required filings, including the new Form BD, are completed accurately and submitted on time. Finally, consult with legal and compliance departments if any ambiguities or complex financial arrangements are present. Question 11. The efficiency study reveals a pattern of proprietary trades executed by the firm's trading desk that appear to inflate trading volume in certain thinly traded securities. As a principal of a registered broker-dealer in California, what is the most appropriate course of action to ensure compliance with SEC Rule 15C1-1 definitions? Option A. Immediately halt all proprietary trading activities until a comprehensive external audit can be completed. Option B. Accept the assurances of the head trader that all proprietary trades are legitimate and for the purpose of market making without further investigation. Option C. Focus only on customer account activity, as Rule 15C1-1 definitions primarily apply to transactions involving client funds. Option D. Conduct a detailed review of the proprietary trading desk's activity logs, trade confirmations, and internal communications to determine if any trades constitute manipulative or deceptive devices, as defined by Rule 15C1-1. The correct answer is D. Conduct a detailed review of the proprietary trading desk's activity logs, trade confirmations, and internal communications to determine if any trades constitute manipulative or deceptive devices, as defined by Rule 15C1-1. Explanation. The efficiency study reveals a potential conflict of interest within the firm's proprietary trading desk. This scenario is professionally challenging because it requires a principal to distinguish between legitimate proprietary trading activities and those that could be construed as manipulative or deceptive practices under SEC Rule 15C1-1, specifically concerning wash sales or matched orders. The principal must exercise careful judgment to ensure compliance with federal securities laws and protect investors from market manipulation, even when the firm stands to profit. The best approach involves a thorough review of the proprietary trading desk's activity logs, trade confirmations, and internal communications. This review should focus on identifying any patterns or specific trades that could be interpreted as creating a false or misleading appearance of active trading in a security, or that involve the same person or persons buying and selling the same security for the purpose of creating a misleading impression of market activity. This aligns with the definition of manipulative or deceptive devices under Rule 15C1-1, which prohibits such activities. By proactively investigating and documenting the nature of the trades, the principal can determine if they constitute prohibited practices and take appropriate corrective action, thereby upholding the firm's duty of fair dealing and compliance with SEC regulations in California. An incorrect approach would be to dismiss the findings of the efficiency study solely because the proprietary trades were executed by the firm's own capital and did not involve customer accounts. Rule 15C1-1's definitions of manipulative and deceptive devices apply to any transaction effected for the account of a broker, dealer, or any person acting for them, regardless of whether customer funds are involved. Ignoring potential manipulation simply because it's proprietary trading is a significant regulatory failure. Another incorrect approach would be to rely on the assurance of the head trader that all proprietary trades are legitimate and for the purpose of market making or hedging without independent verification. While market making is a legitimate activity, the definition of manipulative devices under Rule 15C1-1 is broad enough to encompass activities that, even if presented as market making, are designed to create a false impression of activity. A principal has a supervisory responsibility to ensure compliance, which necessitates independent verification rather than blind acceptance of assurances. Finally, an incorrect approach would be to simply halt all proprietary trading activities without a proper investigation. While this might seem like a safe measure, it fails to address the underlying issue and could lead to unnecessary business disruption. The goal is to identify and prevent manipulative practices, not to indiscriminately shut down legitimate trading activities. A proper investigation is required to differentiate between legitimate proprietary trading and prohibited manipulative or deceptive acts as defined by Rule 15C1-1. Professionals should employ a risk-based approach to supervision. This involves identifying areas of potential regulatory exposure, such as proprietary trading desks, and implementing robust monitoring and review processes. When red flags are raised, as in this case by the efficiency study, professionals must conduct thorough, independent investigations, document their findings, and take appropriate action to ensure compliance with all applicable securities laws and regulations, including the definitions provided in SEC Rule 15C1-1. Question 12. Risk assessment procedures indicate that a prospective registered representative applicant for a Series 24 license in California has disclosed 2 prior disciplinary actions from FINRA during their previous employment. The applicant states these were minor issues from many years ago and are not relevant to their current desire to become a principal. As the principal responsible for their registration, what is the most appropriate course of action to fulfill your obligations under FINRA Rule 3110E? Option A. Conduct a thorough investigation into the nature, circumstances, and resolution of each disciplinary action, obtaining relevant documentation, and assessing the applicant's current suitability based on the findings. Option B. Register the applicant immediately, assuming their strong current sales performance demonstrates their suitability and negates any past issues. Option C. Accept the applicant's assurance that the disciplinary actions were minor and unrelated, and proceed with the registration process without further inquiry. Option D. Forward the applicant's disclosure to their previous firm and rely solely on their assessment of the disciplinary actions before making a decision. The correct answer is A. Conduct a thorough investigation into the nature, circumstances, and resolution of each disciplinary action, obtaining relevant documentation, and assessing the applicant's current suitability based on the findings. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a principal to balance the firm's need to expand its sales force with the paramount regulatory obligation to ensure that all registered individuals meet the required standards of character and competence. The principal must exercise due diligence in investigating an applicant whose background raises potential red flags without succumbing to pressure or making assumptions. The integrity of the securities markets and the protection of investors depend on the principal's thoroughness and adherence to FINRA Rule 3110E. Correct approach analysis. The best professional practice involves a comprehensive and documented investigation into the applicant's background, specifically addressing the disclosed disciplinary actions. This approach requires the principal to proactively seek detailed information about the nature, severity, and resolution of the prior disciplinary events. This includes obtaining copies of the disciplinary orders, understanding the underlying conduct, and assessing whether the applicant has demonstrated rehabilitation, or if the past issues pose a current risk to investors or the firm. This aligns directly with the responsibility under FINRA Rule 3110E to investigate applicants for registration, ensuring they are qualified and of good character. Incorrect approaches analysis. One incorrect approach involves accepting the applicant's assurance that the disciplinary actions were minor and unrelated to financial misconduct without independent verification. This fails to meet the investigative duty mandated by FINRA Rule 3110E, as it relies on self-serving statements rather than objective evidence. It creates a significant risk that the firm is registering an individual who may pose a threat to investors or the firm's reputation. Another incorrect approach is to proceed with registration based solely on the applicant's current sales performance, assuming that success in the role negates any past issues. While sales performance is important, it does not absolve the principal of the responsibility to investigate past disciplinary actions. FINRA Rule 3110E requires an investigation into an applicant's background, irrespective of their perceived current capabilities. Past conduct can be indicative of future behavior or a lack of integrity. Finally, an incorrect approach is to delegate the entire investigation to the applicant's previous employer without conducting any independent review or follow-up. While gathering information from previous employers is part of a thorough investigation, the ultimate responsibility for ensuring the applicant's suitability rests with the registering firm's principal. Relying solely on another entity's assessment without due diligence is a failure to uphold the firm's regulatory obligations. Professional reasoning. Professionals facing such situations should adopt a systematic approach. First, identify all disclosed red flags or potential concerns. Second, determine the specific information needed to address each concern, referencing relevant regulatory rules, like FINRA Rule 3110E. Third, implement a plan to gather this information through direct inquiry, document review, and communication with relevant parties. Fourth, critically evaluate the gathered information to assess the applicant's character, competence, and overall suitability for registration. Finally, document the entire process and the rationale for the decision to register or not register the individual. This structured approach ensures compliance and protects both the firm and the investing public. Question 13. The risk matrix shows a potential for significant operational disruption and reputational damage if a firm undergoes a change in ownership without proper regulatory oversight. A registered broker-dealer in New York is considering a significant change in its ownership structure, where a new entity will acquire a majority stake. What is the most prudent course of action for the firm's principal to ensure compliance with FINRA regulations regarding this change? Option A. Immediately prepare and submit a Form BD filing to FINRA detailing the proposed change in ownership, seeking approval well in advance of the transaction's completion. Option B. Obtain verbal confirmation from a FINRA district office representative that the proposed ownership change is unlikely to require a formal application before proceeding. Option C. Complete the ownership change and then submit a Form BD filing to FINRA, explaining the circumstances of the acquisition. Option D. Proceed with the change in ownership, assuming that since the firm's day-to-day operations will not immediately change, a formal application is not required. The correct answer is A. Immediately prepare and submit a Form BD filing to FINRA detailing the proposed change in ownership, seeking approval well in advance of the transaction's completion. Explanation. The risk matrix shows a potential for significant operational disruption and reputational damage if a firm undergoes a change in ownership without proper regulatory oversight. This scenario is professionally challenging because it requires a principal to balance the firm's business objectives with its stringent regulatory obligations under FINRA rules. A failure to adhere to these rules can lead to severe penalties, including fines and suspension. The best professional approach involves proactively identifying the need for a Form BD filing and submitting it to FINRA well in advance of the proposed change. This approach is correct because Rule 1017 of the Securities Exchange Act of 1934, as interpreted and enforced by FINRA, mandates that member firms must file an application for approval of a change in ownership, control, or business operations if it meets certain thresholds. Prompt and accurate filing demonstrates compliance and allows FINRA sufficient time to review the application, ensuring the new ownership or control structure does not compromise the firm's ability to meet its regulatory responsibilities and protect investors. This proactive stance minimizes disruption and avoids potential regulatory violations. An incorrect approach would be to proceed with the change in ownership without filing the required application, assuming the change is minor or internal. This is a significant regulatory failure because it bypasses FINRA oversight mechanism designed to assess the fitness and capability of new owners or controllers. It also violates the spirit and letter of Rule 1017, which is designed to prevent individuals or entities with disqualifying backgrounds from gaining control of registered broker-dealers. Another incorrect approach would be to file the Form BD application only after the change in ownership has been finalized. This is problematic as it creates a fait accompli situation for the regulator and may indicate a lack of understanding or disregard for the application process. FINRA review process is intended to occur asterisk before asterisk. The change takes effect to ensure ongoing compliance and investor protection. Delaying the filing can lead to the firm operating in violation of regulations during the interim period. Finally, an incorrect approach would be to seek informal guidance from a FINRA district office representative and proceed based solely on that verbal advice without submitting the formal application. While informal guidance can be helpful, it does not substitute for the formal application process required by Rule 1017. Relying solely on informal advice without formal submission is a regulatory risk, as the representative's advice may not encompass all nuances of the rule or the specific circumstances, and it lacks the official approval necessary to legitimize the change. Professionals should approach such situations by first thoroughly understanding the scope of Rule 1017 and its application to any proposed change in ownership, control, or business operations. They should then consult the firm's compliance department and legal counsel to determine the specific filing requirements. The decision-making process should prioritize regulatory compliance and investor protection, ensuring all necessary applications are filed accurately and in a timely manner, well in advance of any proposed transaction. Question 14. Process analysis reveals that a registered representative in Ontario, Canada, has received a request from a long-standing client to use a portion of their investment account's cash balance to cover a personal, short-term loan to another individual, with the understanding that the funds will be repaid with interest. As the general securities principal overseeing this representative, what is the most appropriate course of action to ensure compliance with Ontario securities regulations? Option A. Suggest the representative facilitate the loan by transferring the funds directly from the client's account to the third party, as this is a common practice among financial advisors. Option B. Decline the request, explaining to the client that using client funds for personal loans to third parties is prohibited under Ontario securities law, and explore alternative, compliant methods for the client to access funds if needed. Option C. Advise the representative to proceed with the request, assuming the client is sophisticated and understands the risks involved. Option D. Immediately approve the request, as the client has explicitly stated it is a loan with interest, implying a legitimate transaction. Correct answer is B. Decline the request, explaining to the client that using client funds for personal loans to third parties is prohibited under Ontario securities law, and explore alternative, compliant methods for the client to access funds if needed. Explanation. Scenario analysis. This scenario presents a common ethical and regulatory challenge for principals in the securities industry. The core difficulty lies in balancing a client's stated desire with the firm's and the principal's regulatory obligations to protect customer assets and prevent prohibited activities. The principal must discern whether the client's request, if fulfilled, would constitute an improper use of securities or funds, or a prohibited guarantee, all within the specific regulatory framework of Ontario, Canada. This requires a deep understanding of the Securities Act, Ontario, and related regulations governing the conduct of registered firms and individuals. Correct approach analysis. The best professional approach involves a thorough review of the client's request against the prohibitions outlined in Ontario securities law, specifically concerning the improper use of customer securities or funds and the prohibition against guarantees. This approach prioritizes client protection and regulatory compliance. The principal should first confirm that the client's request does not involve the firm or the principal using the client's securities or funds for any purpose other than the client's benefit, such as for the firm's operational expenses or for the personal benefit of the principal. Furthermore, the principal must ensure that the request does not imply or directly constitute a guarantee of investment performance or a return of principal, which is strictly prohibited. If the request, as presented, appears to violate these principles, the principal must decline the request and explain the regulatory reasons to the client, offering alternative, compliant solutions if appropriate. This aligns with the duty of care and the obligation to act in the client's best interest while adhering to the strictures of the Securities Act, Ontario. Incorrect approaches analysis. One incorrect approach involves immediately fulfilling the client's request without a detailed regulatory review. This is problematic because it bypasses the principal's responsibility to ensure compliance with Ontario securities law. The client's request, even if seemingly benign, could inadvertently lead to a violation of rules prohibiting the improper use of customer assets or the provision of guarantees, exposing both the client and the firm to significant risk. Another incorrect approach is to dismiss the client's request outright without understanding the underlying intent or exploring compliant alternatives. While the request might be problematic as stated, a complete refusal without explanation or offering compliant solutions can damage the client relationship and fail to uphold the principle of providing suitable advice and service within regulatory boundaries. A further incorrect approach is to interpret the client's request in the most favorable light possible, assuming no regulatory breach, and proceeding without seeking clarification or confirmation of compliance. This demonstrates a lack of due diligence and a failure to proactively identify and mitigate potential regulatory risks, which is contrary to the principal's oversight responsibilities. Professional reasoning. Professionals in Ontario must adopt a proactive and compliance-first mindset. When faced with a client request that touches upon sensitive areas like the use of funds or potential guarantees, the decision-making process should involve 1. Understanding the client's objective. 2. Identifying potential regulatory implications under the Securities Act, Ontario and related rules. 3. Consulting internal compliance policies and, if necessary, legal counsel. 4. Communicating clearly and transparently with the client about what is permissible and why. 5. Offering compliant alternatives that meet the client's underlying needs. This systematic approach ensures both client satisfaction and adherence to regulatory standards. Question 15. The performance metrics show a notable surge in unsolicited customer orders for a volatile technology stock, all originating from a recently onboarded registered representative, the firm's Miami, Florida office. As the general securities principal responsible for supervising this representative, which of the following actions best addresses this situation in compliance with FINRA and Florida state securities regulations? Option A. Acknowledge the increased activity as a sign of the representative's early success and monitor future performance without immediate further investigation. Option B. Immediately place a temporary hold on all trading activity for the new representative pending a full internal audit of their client communications. Option C. Focus solely on reviewing the representative's personal trading history for any potential conflicts of interest or rule violations. Option D. Initiate a detailed review of the representative's customer accounts for suitability. Cross-reference the transactions with firm policies on unsolicited orders, and engage in a direct discussion with the representative to understand their client interactions, while also informing the compliance department. The correct answer is D. Initiate a detailed review of the representative's customer accounts for suitability, cross-reference the transactions with firm policies on unsolicited orders, and engage in a direct discussion with the representative to understand their client interactions, while also informing the compliance department. Explanation. The performance metrics show a significant increase in unsolicited customer orders for a particular speculative stock, originating from a newly hired registered representative in the firm's Florida branch office. This scenario is professionally challenging because it raises immediate concerns about potential sales practice violations, specifically related to suitability, and the firm's supervisory responsibilities under FINRA rules and Florida state regulations. The principal must act swiftly and decisively to investigate without unduly disrupting legitimate business operations or unfairly penalizing the new representative without cause. The best approach involves a proactive and thorough investigation that prioritizes regulatory compliance and customer protection. This entails immediately reviewing the representative's customer accounts for suitability concerns related to these specific transactions, cross-referencing the orders with the firm's internal policies and procedures for handling unsolicited trades, and initiating a direct conversation with the new representative to understand their sales activities and client interactions. Simultaneously, the principal should notify the firm's compliance department and legal counsel to ensure all actions align with FINRA Rule 3110, supervision, and relevant Florida Securities Act requirements regarding principal oversight and sales practice supervision. This comprehensive review ensures that the firm fulfills its duty to supervise and that customer interests are protected, while also providing the new representative with appropriate guidance or corrective action if needed. An incorrect approach would be to dismiss the performance metrics as simply indicative of a successful new hire, without further inquiry. This failure to investigate potential red flags related to suitability and supervision would violate FINRA Rule 3110 and the Florida Securities Act's emphasis on diligent supervision. It exposes the firm and the principal to significant regulatory risk and potential harm to customers. Another incorrect approach would be to immediately restrict the representative's trading activity without any preliminary investigation or discussion. While caution is warranted, such an action without a basis in observed or reported violations could be considered an overreach and potentially unfair to the representative, especially if the increased activity is legitimate. However, the primary failure here is the lack of a structured, compliant investigative process. A further incorrect approach would be to only review the representative's personal trading records. While personal trading is subject to oversight, the core issue here relates to customer transactions and the firm's supervision of those transactions. Focusing solely on personal trading would neglect the critical supervisory responsibilities concerning customer accounts and sales practices, thereby failing to address the root of the potential problem under FINRA and Florida regulations. Professionals should employ a decision-making framework that begins with identifying potential risks and regulatory obligations. This involves understanding the specific rules governing supervision and sales practices in their jurisdiction, in this case, FINRA and Florida. Upon identifying a potential issue, the next step is to gather information through a structured and compliant investigation, consulting with compliance and legal departments as necessary. The final step involves taking appropriate, well-documented action based on the findings, ensuring that both customer protection and regulatory adherence are paramount. Question 16. The performance metrics show a consistent decline in the timely completion of required anti-money laundering (AML) reporting for client accounts within a securities firm operating in Ontario, Canada. As a general securities principle, what is the most appropriate immediate course of action to address this trend? Option A. Document the performance metric shortfalls in a compliance log and await the next scheduled internal audit to address the issue. Option B. Initiate a comprehensive review of the firm's AML policies and written supervisory procedures, WSB. Conduct a root cause analysis of the reporting delays, implement targeted staff training, and formally update the WSB with a clear timeline for re-evaluation of the metrics. Option C. Defer any corrective actions related to AML reporting until the firm's annual policy review, as the current metrics do not yet indicate a severe breach. Option D. Issue a general memo to all staff reminding them of their AML reporting obligations and attribute the delays to individual staff oversight. Correct answer is B. Initiate a comprehensive review of the firm's AML policies and written supervisory procedures, WSB. Conduct a root cause analysis of the reporting delays, implement targeted staff training, and formally update the WSB with a clear timeline for re-evaluation of the metrics. Explanation. The performance metrics show a concerning trend in the firm's compliance with anti-money laundering (AML) regulations in Ontario, Canada. This scenario is professionally challenging because it requires a principal to not only identify a compliance issue, but also to implement a robust and timely corrective action plan that aligns with FinTrack, Financial Transactions and Reports Analysis Centre of Canada, guidelines and the firm's own written supervisory procedures, WSB. The principal must balance operational efficiency with the paramount importance of regulatory adherence and the firm's reputation. The best approach involves immediately initiating a comprehensive review of the firm's AML policies and WSB, specifically targeting the identified performance metric deficiencies. This includes a root cause analysis to understand why the metrics are falling short, followed by the development and implementation of targeted training for relevant staff. Crucially, this approach mandates a formal update to the WSB to reflect any necessary procedural changes and establishes a clear timeline for re-evaluation of the metrics to ensure the corrective actions are effective. This aligns directly with the principal's responsibility under securities regulations in Ontario to supervise the firm's activities and ensure compliance with all applicable laws and guidelines, including those set by FinTrack. The proactive and systematic nature of this response demonstrates a commitment to regulatory integrity and risk mitigation. An approach that involves merely documenting the performance metric shortfalls without a concrete plan for remediation is professionally unacceptable. This failure to act constitutes a dereliction of supervisory duty, as it allows a known compliance gap to persist, increasing the firm's exposure to regulatory penalties and reputational damage. It also violates the principle of developing and updating WSB to address identified risks. Another unacceptable approach is to attribute the performance metric issues solely to staff performance without investigating systemic policy or procedural weaknesses. While individual performance can be a factor, a principal's responsibility is to assess the broader context, including the adequacy of training, the clarity of procedures, and the effectiveness of supervisory oversight. Ignoring potential policy or WSB deficiencies is a failure to fulfill the obligation to ensure the firm's procedures are robust and effective. Finally, an approach that delays the implementation of corrective actions until the next scheduled policy review cycle is also professionally unsound. Regulatory compliance, particularly in areas like AML, requires prompt attention to identified issues. Postponing necessary updates and training allows the compliance risk to escalate, potentially leading to more severe consequences for the firm and its clients. Professionals should approach such situations by first recognizing the urgency of compliance issues. A structured decision-making process involves 1. Identifying the specific regulatory requirement or internal policy that is being breached. 2. Conducting a thorough root cause analysis to understand the underlying reasons for the noncompliance. 3. Developing a clear, actionable plan with defined responsibilities and timelines for remediation. 4. Implementing the plan, which may include policy updates, enhanced training, and revised supervisory checks. 5. Monitoring the effectiveness of the corrective actions and making further adjustments as needed. This systematic approach ensures that compliance issues are addressed comprehensively and effectively, safeguarding the firm and its clients. Question 17. Cost-benefit analysis shows that a new alternative investment product offered by a third-party vendor has the potential to significantly increase the firm's revenue in California. The vendor claims the product is compliant and has provided marketing materials. As a general securities principle in California, what is the most prudent course of action before allowing registered representatives to offer this product to clients? Option A. Approve the product for sale based on the vendor's assurances of compliance and the projected revenue increase, assuming the marketing materials are sufficient. Option B. Delegate the entire assessment and approval process to the firm's compliance department, trusting their expertise to ensure regulatory adherence. Option C. Proceed with offering the product after a brief review of the marketing materials and a quick discussion with the vendor about its general characteristics. Option D. Conduct a thorough due diligence review of the product's structure, risks, fees, liquidity, and suitability for the firm's typical client base, and ensure registered representatives receive adequate training on its features and risks. The correct answer is D. Conduct a thorough due diligence review of the product's structure, risks, fees, liquidity, and suitability for the firm's typical client base, and ensure registered representatives receive adequate training on its features and risks. Explanation. This scenario presents a professional challenge because it requires a principal to balance the firm's desire for growth and revenue with their fundamental obligation to act in the best interests of clients, and to ensure that products offered are suitable and compliant with FINRA regulations. The principal must assess the potential risks and benefits of a new product not just from a profitability standpoint, but also from a client suitability and regulatory compliance perspective. Careful judgment is required to avoid offering products that may be overly complex, carry undisclosed risks, or are not appropriate for the firm's typical client base. The best approach involves a thorough, multifaceted review that prioritizes client protection and regulatory adherence. This includes a detailed examination of the product's structure, underlying assets, fees, liquidity, redemption terms, and potential risks. Crucially, it necessitates an assessment of whether the product aligns with the firm's established customer profiles, and whether the firm's registered representatives possess the necessary knowledge and training to adequately explain the product and its risks to clients. This approach is correct because it directly addresses the core responsibilities of a Series 24 principal under FINRA Rule 3110, Supervision, and FINRA Rule 2111, Suitability. By ensuring the product is understood, suitable, and that representatives are prepared, the principal upholds their duty to supervise and protect investors. An incorrect approach would be to approve the product based solely on the projected revenue and the vendor's assurances of compliance. This fails to meet the principal's supervisory obligations, as it bypasses a critical due diligence step. The firm's revenue goals, while important, cannot supersede the regulatory mandate to offer suitable products and to ensure adequate supervision. Another incorrect approach is to delegate the entire assessment to the compliance department without active principal oversight and independent judgment. While compliance plays a vital role, the principal remains ultimately responsible for the supervision of the firm's business activities and the products it offers. Relying solely on another department without engaging in a thorough personal review is a dereliction of duty. Finally, approving the product with only a cursory review of the marketing materials and a brief discussion with the vendor is also professionally unacceptable. This superficial assessment does not provide the depth of understanding required to identify potential risks or suitability concerns, leaving both the firm and its clients exposed to undue risk and potential regulatory violations. Professionals should adopt a systematic decision-making process that begins with understanding the regulatory landscape and the firm's obligations. This is followed by a comprehensive due diligence process for any new product or service, focusing on client impact, risk assessment, and operational feasibility. Open communication with compliance, legal, and sales teams is essential, but the principal must exercise independent judgment and take ultimate responsibility for decisions that affect client interests and regulatory compliance. Question 18. The assessment process reveals that a registered representative in California is considering recommending a particular series of mutual funds to a client. The representative is aware that these funds have historically performed well and that selling them would result in a favorable commission structure for their firm. The representative has a general understanding of the client's desire to grow their assets, but has not recently reviewed the client's specific financial situation, risk tolerance, or investment time horizon in detail. Which of the following represents the most appropriate course of action for the representative? Option A. Conduct a thorough review of the client's current financial situation, investment objectives, risk tolerance, and time horizon, and then determine if the recommended mutual funds are suitable for the client, ensuring all required disclosures, including the prospectus, are provided. Option B. Recommend the mutual funds based on their strong historical performance and the representative's general knowledge of the client's growth objective, proceeding with the sale as it aligns with the client's stated desire for asset growth. Option C. Prioritize the recommendation of these specific mutual funds due to their attractive commission structure, assuming that strong historical performance is sufficient to meet the client's growth objective. Option D. Proceed with the recommendation of the mutual funds and provide the client with the prospectus after the sale has been completed, as the client's primary goal is asset growth. The correct answer is A. Conduct a thorough review of the client's current financial situation, investment objectives, risk tolerance, and time horizon, and then determine if the recommended mutual funds are suitable for the client, ensuring all required disclosures, including the prospectus, are provided. Explanation. The assessment process reveals a scenario that is professionally challenging due to the inherent conflict between a registered representative's desire to offer a diverse range of investment products and the strict regulatory requirements governing the sale of investment company securities in California. The representative must navigate the complexities of disclosure, suitability, and potential conflicts of interest, all while ensuring compliance with the California Corporations Code and FINRA rules. Careful judgment is required to balance client needs with regulatory obligations. The best approach involves a thorough understanding of the specific investment company security being recommended, including its objectives, risks, fees, and expenses, and then meticulously matching these characteristics to the client's stated financial situation, investment objectives, risk tolerance, and time horizon. This includes verifying that the representative has a reasonable basis to believe the security is suitable for the particular customer. Furthermore, the representative must ensure all required disclosures, including the prospectus, are provided to the client in a timely manner, and that any potential conflicts of interest are disclosed. This aligns with the principles of suitability under FINRA Rule 2111 and the disclosure requirements mandated by both FINRA and California state securities laws, ensuring the client is fully informed and the recommendation is appropriate. An incorrect approach would be to recommend a mutual fund solely based on its past performance, without a comprehensive review of the client's financial profile. This fails to meet the suitability standard, as past performance is not indicative of future results, and a recommendation must be based on the client's individual circumstances. Another incorrect approach is to prioritize the sale of a particular investment company security because it offers a higher commission to the representative, without adequately considering if it is the most suitable option for the client. This introduces a conflict of interest and violates ethical obligations and regulatory requirements to act in the client's best interest. Finally, recommending an investment company security without providing the client with the prospectus or other essential disclosure documents is a direct violation of disclosure rules, leaving the client uninformed about critical aspects of the investment. Professionals should employ a decision-making framework that begins with a deep dive into the client's financial profile and investment objectives. This should be followed by a thorough due diligence of the investment product, understanding its features, risks, and costs. The core of the decision-making process is the suitability analysis, where the product's characteristics are directly compared against the client's profile. Any potential conflicts of interest must be identified and disclosed. Finally, all necessary documentation must be provided to the client in accordance with regulatory timelines. Question 19. Quality control measures reveal that a registered broker-dealer in California is considering establishing a new, wholly owned subsidiary. This subsidiary will focus exclusively on providing back-office administrative support and technology services to unrelated third-party investment advisors. The principal is unsure whether this subsidiary, by virtue of its business activities, will be considered a member of SIP under Section 3(a)(2)(a) of the Securities Investor Protection Act of 1970. Which of the following approaches best ensures compliance with SIP membership requirements? Option A. Assume SIP membership is not required because the subsidiary will not directly handle customer securities or cash, and its primary function is administrative support. Option B. Obtain a verbal confirmation from the firm's outside legal counsel that the subsidiary is unlikely to require SIP membership based on its administrative role. Option C. Conduct a detailed review of the subsidiary's proposed business plan and operational activities to confirm they do not fall within the exclusions for SIP membership as defined in Section 3(a)(2)(a) of SEPA. Option D. Delay a formal determination of SIP membership until the subsidiary has been operating for a period and its actual business activities can be assessed. The correct answer is C. Conduct a detailed review of the subsidiary's proposed business plan and operational activities to confirm they do not fall within the exclusions for SIP membership as defined in Section 3(a)(2)(a) of SEPA. Explanation. Scenario analysis. This scenario is professionally challenging because it requires a principal to navigate the nuances of SIP membership eligibility for a newly formed entity. Misinterpreting the criteria can lead to significant regulatory violations, reputational damage, and potential financial penalties for both the firm and the individuals involved. The principal must exercise careful judgment to ensure compliance with the Securities Investor Protection Act of 1970, SEPA, and its related regulations. Correct approach analysis. The best professional practice involves proactively verifying the entity's business activities against the exclusions outlined in Section 3(a)(2)(a) of SEPA. This means confirming that the entity is not primarily engaged in the business of underwriting, distributing, selling, or dealing in securities, or providing investment advice, which are activities that would typically necessitate SIP membership. The correct approach involves a thorough review of the entity's formation documents, business plan, and anticipated revenue streams to definitively establish its non-covered status. This aligns with the principle of due diligence and the responsibility of a principal to ensure that all associated entities operate in full compliance with federal securities laws. Incorrect approaches analysis. One incorrect approach involves assuming SIP membership is not required simply because the entity is a subsidiary and does not directly handle customer funds. This is a flawed assumption because SIP membership is determined by the nature of the business activities conducted, not solely by the firm's structure or its direct handling of customer assets. If the subsidiary engages in activities that fall within the scope of SIP coverage, It would likely be required to be a member or be covered by its parent's membership, depending on specific circumstances and SEC/SIPC interpretations. Another incorrect approach is to rely solely on the opinion of legal counsel without independent verification of the entity's business activities against SEPA-specific exclusions. A legal counsel's advice is valuable. The principal has a direct responsibility to understand and apply the regulatory requirements. A superficial reliance on counsel, without ensuring the underlying facts presented to counsel accurately reflect the entity's operations, can lead to compliance failures. The principal must ensure the business activities align with the legal opinion and the statutory exclusions. A further incorrect approach is to defer the decision until the entity begins operations and potential issues arise. This reactive stance is contrary to the proactive compliance expected of securities principles. Waiting for problems to emerge increases the risk of non-compliance, potential customer harm, and regulatory scrutiny. The regulatory framework mandates that firms assess and ensure compliance before engaging in activities that could trigger membership requirements. Professional reasoning. Professionals should adopt a proactive and diligent approach to compliance. This involves understanding the specific regulatory requirements applicable to their business and any associated entities. When faced with questions of SIPC membership, a principal should 1. Thoroughly review the relevant statutory provisions, in this case, Section 3(a)(2)(a) of SEPA and any interpretive guidance from the SEC and SIPC. 2. Meticulously analyze the business activities of the entity in question against these provisions. 3. Consult with legal and compliance departments to confirm their understanding and application of the rules. And 4. Document the decision-making process and the basis for determining SIPC membership status. This systematic approach ensures that decisions are well-informed, compliant, and protect both the firm and its customers. Question 20. Strategic planning requires a principal of a FINRA member firm located in California to assess the firm's compliance with record-keeping requirements under FINRA Rule 4511. The firm has been using a digital record-keeping system for the past 8 years, which was implemented when the firm was established. Principal is concerned that the system's older architecture might not fully comply with current accessibility and retention standards, especially considering the firm's growth and the increasing volume of transactions. The principal needs to determine the most effective and compliant method to ensure the firm meets its obligations. Option A. Investigate the feasibility of migrating to a new, more modern record-keeping system, prioritizing the lowest cost option available, even if it means a temporary disruption in accessibility during the transition. Option B. Delegate the task of reviewing the record-keeping system's compliance to the firm's most junior administrative assistant, trusting their diligence to identify any potential issues. Option C. Conduct a comprehensive audit of the firm's current record-keeping system and procedures, comparing them directly against the specific requirements of FINRA Rule 4511, including accessibility, format, and retention periods, and implement any necessary upgrades or modifications to ensure full compliance. Option D. Assume the existing 8-year-old system is compliant as long as the records are still accessible, and focus compliance efforts on newer regulations. Correct answer is C. Conduct a comprehensive audit of the firm's current record-keeping system and procedures, comparing them directly against the specific requirements of FINRA Rule 4511, including accessibility, format, and retention periods, and implement any necessary upgrades or modifications to ensure full compliance. Explanation. Strategic planning requires a thorough understanding of regulatory requirements, particularly concerning the maintenance of accurate and accessible records. This scenario presents a professional challenge because the principal must balance the firm's operational efficiency with its absolute obligation to comply with FINRA Rule 4511 regarding books and records. The potential for significant regulatory penalties, including fines and disciplinary actions, necessitates meticulous attention to detail and adherence to established procedures. The principal's judgment is critical in ensuring that record-keeping practices are not only compliant, but also robust enough to withstand regulatory scrutiny. The best approach involves a systematic review of the firm's record retention policies and procedures, cross-referencing them with FINRA Rule 4511. This includes verifying that all required records are maintained in a readily accessible format for the prescribed retention period, typically 6 years for most FINRA-related records, with the first 2 years in an easily accessible location. The principal should also confirm that the firm has implemented adequate controls to ensure the integrity and accuracy of these records, such as regular audits and training for staff responsible for record keeping. This proactive and comprehensive review ensures that the firm is not only meeting its minimum regulatory obligations, but is also operating with a strong compliance culture, thereby mitigating risk. An incorrect approach would be to rely solely on the assumption that the firm's existing, albeit older, system is sufficient without a current verification against the specific requirements of FINRA Rule 4511. This overlooks the possibility of changes in regulatory interpretation or the system's degradation over time, potentially leading to noncompliance. Another incorrect approach is to prioritize the cost savings of not upgrading the record-keeping system over regulatory compliance. While cost efficiency is important, it cannot supersede the legal mandate to maintain accurate and accessible records. The potential fines and reputational damage from noncompliance far outweigh any short-term cost savings. Finally, an incorrect approach is to delegate the entire responsibility for record-keeping compliance to junior staff without adequate oversight or verification from the principal. While delegation is necessary, the ultimate responsibility for ensuring compliance rests with the principal. A lack of direct oversight can lead to overlooked deficiencies and a failure to identify and rectify issues before they become significant problems. Professionals should adopt a decision-making framework that prioritizes regulatory compliance as a foundational element of business operations. This involves a continuous cycle of assessment, implementation, and monitoring of compliance procedures. When faced with record-keeping challenges, the process should involve 1. Identifying the specific regulatory requirements, e.g., FINRA Rule 4511. 2. Assessing current practices against these requirements. 3. Identifying any gaps or deficiencies. 4. Developing and implementing corrective actions. And 5. Establishing a system for ongoing monitoring and periodic review. This systematic approach ensures that compliance is an integrated and active component of the firm's operations, rather than an afterthought.